So after a busy 2023, I suppose this is the prime time now for planning for the year ahead. It's naturally for most industries a bit quieter, and there's some space in the day to really start to set some objectives as to where we want to be by December 2024. Thomas, from chatting to merchants, anything that stood out to you that's maybe front of their mind?
I suppose looking firstly back at the at 2023 as a whole, I think coming into the end of 2022, people probably thought that the economy might have fallen a lot harder than it actually did in 2023. So I think a lot of e-commerce businesses were probably a little bit surprised in some way that they probably did a little bit better than they might have initially had forecasted in 2022, which is obviously fantastic. I think going into 2024 as well, I can see that trend continuing. A lot of the brands we're working with have done extremely well in the last couple of months. And broadly, even looking at the Shopify BFCM numbers, up 25% year to date, average order value up, general spend up in general. So, 2023 was really, really positive. And yeah, looking, I suppose I've over the last couple of weeks, we would have gone through a number of growth plans with a lot of our existing customers and trying to help plan out what 2024 is going to look like. I've kind of just maybe scribbled down a couple of key themes there that kind of came up a lot throughout some of those conversations.
Definitely. I know one, and obviously it's very much our bread and butter. So we're I suppose speaking our own language here, but the shift away from revenue to profitability metrics has continued to be a focus throughout 2023, more so than ever before. How have you found merchants are thinking about that?
It still requires a bit of education to some extent. Simply forecasting a sales goal number now for 2024 and getting to November and December and you're not there and you feel like you need to get there purely to hit this revenue metric. There's a number of ways you can do that. The optimal way would be to have a great product with great margins that will get you there with a really good marketing mix. That being said, if some of those parts of them, say, aren't fully dialed in, I suppose, in that equation, you can start dialing up your marketing spend or dialing down your discounting. You probably will get that revenue metric you wanted, but it will definitely come at the cost of efficiency. And what I suppose, this has come at a focal point, I suppose, with a lot of the conversations we've had is set your profit goal. Like, figure out what you want out of the business. The business is set up to make money, so figure out what you want out of the business and probably have that as paramount, more so than that revenue metric, because just seeing it time and time again, particularly last year, again, a lot of brands really just chasing revenue metrics, and ultimately it's a vanity metric at the end of the day. There's other ways you can do it between reducing marketing spend. Often brands are spending heavily on Meta and Google, and there could be often a lot of wasted spend in there. Often reducing operating costs and different capacities there helps as well. So there is a lot of different ways to do it that really will help your profitability. High sales don't always equal high profits.
Definitely. I think as you put it there, like, it's an easier metric to, it's relatively malleable. There's ways to kind of cheat the system, both fairly and unfairly, to kind of get to that goal. But I suppose at what cost is the key outcome there? Is it actually worth our while? And I think as well, like, people, again, have had the luxury for the last couple of years through, cheap Facebook ads, through kind of a broader economic environment, which meant that they didn't necessarily have to be as focused on, a profitability metric. It was something they could push down the road, but it's certainly more aligned now. There's a higher bar, but at least everyone's operating on the same page. Whether they have that page clearly with the kind of roadmap as to what they want to do, but it's definitely moving in that direction. And one thing we've consistently seen is obviously that's both on the variable cost side, whereby, we're really using contribution margin and, treating your ad spend nearly as a part of your variable cost. We'll come back to that in a second. But one other area that ultimately bloats over time is that operational expense line. How have you found that for merchants?
Yeah, I suppose just one last point in the revenue before we move on to the OpEx piece. It needs to come from the top down, really. Like, if you're a manager or a founder of an e-commerce business and you're going to KPI your agency or your e-com managers on the revenue-orientated metrics, it will lead to perverse incentives to hit them that will really just affect you at the end of the day with your profitability. So figure out what that profit goal looks like for you, and that needs to kind of permeate down through your e-com managers or your agencies or whoever else you're working with. Everyone should be working towards that North Star of contribution margin or net profit, as opposed to just hitting revenue metrics, because one will come at the expense of the other, unfortunately. In terms of the operating cost piece, it's an interesting one. I suppose we've been working with a lot of brands this year. I think a lot of operational expense bloat has probably happened in the industry in the last couple of years, probably as a result of really, really high scale. in 2021, and even probably the first half of 2022 as well. E-commerce saw growth like it never really saw before, and businesses really were set up for massive scale, and like to be set up for that scale, they often had to incur a lot of extra costs, whether it was multiple different agencies in the same business, different offices, maybe lots of new software, different consultants in, and things like that. As ad costs have got more and more expensive, and you kind of alluded to a minute ago, I think years of cheap ad costs on Facebook and Google probably bred a lot of bad habits into the industry, in that you didn't really need to think about costs to a certain extent. You didn't really need to think about your operations too much. The cost to acquire a customer was so low that as long as you put money into the Facebook machine, it was coming back at you tenfold for quite a long time. And I think really what the last year has shown us is the Facebook tax, like the Google tax, that really increased customer acquisition cost has just meant that businesses operating in the industry now really need to become a lot more operationally efficient. And unfortunately, one way to do that is to really scrutinize every cost going out of the business, whether it's multiple agencies you have, whether it's a bloated software stack, whether it's a rented office maybe that you don't need in a certain location. There's multiple different ways to look at it, but it's definitely been a key point, I suppose, through a lot of the 2024 planning with a lot of people we've spoken to.
Definitely. It's one that, again, I suppose off the back of a larger kind of net sales or overarching revenue, a larger OPEX may be forgiven by nature of the fact that you're looking to really drive that net sales goal aggressively. And the hope is that, okay, on a percentage basis, that will sit and find its feet where, that will represent a reasonable percentage of this new future sales number, which is where we want to go with the business. But again, if that's not necessarily the plan anymore, or it's not the rewarded behavior by whoever is, whether it's your the business owner and the stakeholders in the business, or maybe it's the broader market and anyone who's placing a value on your business, it's potentially not as beneficial as well. And I suppose in addition to that OPEX side, we obviously have the core contribution margin piece, as we referenced there. I think even just to kick that off, I think ultimately the main kind of a big challenge that a lot of brands have had, not only in terms of the change in that cost per acquisition, but even the fact that it's so variable in the first place. If somebody's product cost jumped up and down as much as their cost per acquisition, there would be riots in the streets. But ultimately, because it's not treated as a variable cost, and previously that was expected because you couldn't really attribute marketing in as effective as a way as you can today, even though it's very murky. You do have a cost of ads that will result in a certain amount of sales on a daily, weekly, or monthly basis. How have you found that process for merchants?
Yeah, again, I think the idea of contribution margin, it's not new. It's definitely not new, but I think it's definitely picking up a lot of steam in D2C for all the reasons you've kind of just alluded to there. And again, I think this needs to permeate from the top down, or if you are looking to impress the business that you are working in, you need to get the profitability, particularly as you mentioned, the ad costs and the customer acquisition costs going through the roof. You also have supply chain costs going through the roof. So understanding your contribution margin, just to quickly go through what that is, it's your net sales. So again, we're excluding the VAT that you would see in your Shopify. We're taking out all of your costs to go to making sure you actually understand your full COGS is also really, 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 really important for every brand. And it's one I think we've both seen this year that a lot of brands get wrong. Your COGS are not just product costs. So you have product costs, you've shipping, transaction fees, fulfillment fees, and then your return costs. So net sales minus your full COGS minus your full marketing spend. What you have left then is your profit, but it's your profit before your operating expenses. So this is called contribution margin or contribution profit. This is definitely picking up a lot of steam in the industry. We can see it kind of dominating LinkedIn and D2C Twitter, I think, over the last couple of weeks and months, a lot more so than probably it has before. Like, I think a lot of brands we've probably spoken to for the first time about contribution margin can get scared by it. It feels like an accounting metric, and a lot of people we're working with are definitely not accountants. We're not accountants. But what it does do is give you a real true indicator, okay, irrespective of what Facebook or Google are going to say, irrespective of the ROAS that you're getting from Google or Facebook, has the extra spend on marketing been worth it? Okay, you might see your revenue go up, your top line sales revenue go up, but has it actually been worth it for you on the back end? Have you put in more money into your marketing? You've risen sales to a point, but actually you've kind of hit that point of diminishing marginal returns, and even though your sales are going up, you're actually left with less at the end of the day. Have you spent more on marketing and used a discounting strategy where, yes, your revenue's gone through the roof, but you actually could be left with less at the end of the day? So in my personal opinion, it's a catch-all for a real true gauge of success for a lot of businesses, and it's really picking up a lot of steam. And I think if you are looking to, I suppose, get a bit leaner on the business this year, or really trying to grow sustainably and profitably, getting a fundamental understanding of what contribution margin is, what it looks like, will really help you join the dots, I think, between marketing, e-commerce marketing and finance in a way that everyone kind of clearly understands. And again, I would make sure that your e-com managers and your agencies are fully dialed in on what that is for your business and what your contribution margin goals are for the business. Because I suppose one thing we've seen this year is a lot of businesses can actually spend more money than they actually might have thought they could. And like the underlying unit economics of the business actually are much better than the business owner actually might have thought. And what could be holding them back is a lack of clarity on the profitability on the ad spend, because let's face it, it is terrifying for a lot of businesses to increase that ad spend by 30, 40, 50, 60%. But we've seen that with a lot of brands this year. Like one brand we've worked with, I think they've over 5x their ad spend this year. Contribution margin has gone up considerably. And it just means that the operating base, the operating cost of running the business this year largely remain pretty similar. So all that increased contribution margin, all the increased profit after marketing, combined with relatively fixed operating base, has just meant that all the extra efficiency has flowed directly to the bottom line, and the business is just completely transformed.
Definitely. I think the big challenge that people don't realize occurs with ROAS is that it doesn't balance the two sides of the coin, both volume and efficiency. ROAS will really measure how efficient the €1 or dollar you invest in your ads returns in terms of revenue within the business. But every dollar isn't spent equal, and therefore you might be better off spending, let's say, keep it simple, $10 at a 5x ROAS. You might actually, if you spend maybe $100, that might fall to 3x, but you're still actually have a lot more money in the bank even after that kind of those kind of core costs. So ultimately, it's hard to kind of understand exactly what that point of diminishing marginal returns are. How far should we push that spend? And contribution margin can kind of level out that seesaw where it's taking both of those pieces into account, both the volume and also the efficiency. Because again, if that profit is going up, okay, well, perfect. It's worth me continuing to spend. Even if I'm earning less on a per order basis, it's still kind of growing that profit metric overall as well. So I think naturally there's a kind of a tendency to maybe forgive even a lower ROAS if it's a case where lifetime value or kind of a longer sales cycle or customer relationship, I suppose, will make up that difference. I'm willing to forgo my margin in the short term because that customer will buy for me in the future. That's great on principle, and it's something that realistically, if that's the nature, if you're operating in an industry whereby that's reasonable, definitely you need to factor that into your business model. The challenge that people often miss is that definitely is a cash flow implication on making sure you can pay back that customer acquisition cost in a reasonable period of time.
Definitely, and even I suppose on the high ROAS piece as well. We've both spoken to a lot of brands this year, and they come in and they have like high double-digit ROAS, and the thoughts of moving down from a high double-digit ROAS to even like a modest 4 or 5, they'd be like, doesn't sound like it's nonsensical. Because I'm getting €30 for every euro I spend, and you want me to go down to a 4 with increased spend. It doesn't really seem to make sense. But you need to get that balance between the efficiency. Like, I would tell a brand that's doing a 25 ROAS, you're way too efficient, and you're being so efficient that you're actually costing yourself money because you're not willing to scale. Like, would you want 50% of €100, or would you want 10% of like €10,000? It's about getting an understanding, I suppose, and contribution margin will help you do this in terms of how far can you actually push, because what you think is saving you money by staying at that 25 ROAS is actually costing you money because you're not willing to spend. And a lot of people that we speak to actually have really, really good businesses underneath it, and they're not willing to spend because they probably saw a much higher ROAS even in 2020, 2021 as a result of the COVID boom, and that's even subsided down now. But they're still not willing to spend, and they're really not willing to spend because when you get down to the nuts and bolts of it, it's really a lack of understanding in the numbers. They don't understand the unit economics of their business, and it can be a murky and a scary place to get into it. I mean, me and you, we just do this every day of the week. We're digging into these accounts, but an e-commerce operator is they're looking at the marketing, they're looking at the business, they're trying to find product, they're trying to actually run the business as well. They don't have time to get down to the nuts and bolts of the unit economics. And obviously every area of the business is the most important part of the business, but when you're really buying most of your customers and buying most of your orders from the likes of Meta and Google online, it's really, really important to understand the numbers there. How efficiently can you actually buy your customers? And this becomes even more and more important as those ad costs get more and more expensive. What you think could be an ads problem, and you might look at your ads this year and say, okay, we've done okay, but I actually have no profitability at the end of the day. Like trying to figure out, okay, is this actually a marketing problem or is this an operational expense problem? Because often what people think is they have an ads problem, but it's an operating expense problem, and the ads actually could be working better than they actually might know. But the problem is they haven't really given them the juice to really make them actually work. And yeah, it's an interesting one. It's a really, really interesting one.
Yeah, it's a lot of interesting takeaways and a lot of different points front of mind, and it's probably representative of the fact that it's obviously there's so many components to this sector, and ultimately it's so difficult to stay on top of each of these different cost centers and how it actually implicates that end goal of profitability or revenue, whatever the case may be. So maybe just to touch on ultimately how this all plays into people's plans for 2024. In summary, they're moving away from revenue-based metrics. Their operational expenses are under a microscope. They need to understand contribution margin, and they see that. But there's potentially an education piece there in terms of not only understanding what it is, but implementing it within the business, making sure that they're balancing that spend and efficiency and using contribution margin to do so, and then making sure there's not an unfair cash implication on whatever the strategy they've put together is. So the next step is ultimately pulling that together into a forecast for 2024. So a couple of things that we would really suggest businesses take into account, and we'll run through each of these in detail. So number one, you're going to want to reflect on your numbers from the last year and last quarter as expected. Number two, understand what's changed, what assets do you have, and do that typical kind of SWOT analysis. It's typical kind of business school or business class stuff, but it is important to do. Number three, make sure you're reviewing and aligning, I suppose, your broader vision for the business with the tactical approach to the following year. And then let's, pull that all into a yearly plan. So maybe just to break those kind of key points down a little bit more. First and foremost, reflecting and reviewing based on last year. So again, forecasts are guesses at the end of the day. They're an expectation of what's going to happen. And the luxury you have once that time passes is you have a very clear, defined, representation of what actually did happen, grounded in truth, because it's coming directly from your Shopify, your ads manager, whatever the case may be. Now, practically, that's going to test a lot of assumptions. I think the first thing that people often miss is maybe just reflecting on what was my forecast for this year or last year, and ultimately, how did I achieve that? If it's a case where you're wildly off and you're going to use the same method of calculating the forecast for next year, then it's going to be ambitious and might get you excited there looking at that sheet in January, but realistically, is it going to be a useful tool throughout the year? Ultimately, if it's a case where a business can take a step back and say, okay, was my frame of reference, was my methodology in calculating my forecast for the previous year correct? Let's use that as a gauge for success as well.
Definitely, and I would probably start with have a forecast. Spoken to some large businesses this year who are getting forecasts for the very first time this year. So that would be front and center, very first one. Make sure you have a plan to work towards. And as you said, if you had one last year, definitely worth pulling it up now this time of year and say, like, what did we get right? What did we get wrong? Where do we overestimate? Where do we underestimate? And did what we think was going to happen, how did that actually materialize? Because, as you said, if you're way off, you need to rethink, how do we even create that forecast last year? Because chances are, if you were way off last year, you're probably going to be way off again this year, because there is ways to do this. Like, it is a guessing exercise at the end of the day, but there is a much more... We've quite a good refined way, I think, now at this stage of mapping out a good forecast. I mean, we did it for a lot of brands mid-October from Halloween to Christmas Day, and a lot of the brands we have mapped that out with on a week-by-week basis have been exceptionally close with some of them, in fact. So that there is ways to do it, like looking at like previous year's data and extrapolating out what your goals look like, extrapolating out what your anticipated marketing efficiency is going to look like, and really just trying to map out, as we kind of alluded to at the very, very beginning, really you're trying to figure out, how do I get to max profitability? Now again, this is going to be very, very different for every brand, and I suppose this is an important point as well, to understand like what are your goals for next year, because every people might be listening here and say, well, it's obvious I want to make more money, but yeah, that's fine. Do you want to make more sales, or do you want to make more profit? Because they're very, very different things, and they're going to require very, very different strategies in terms of how you're going to achieve both of them. Are you building for an exit, or are you building to get as much top line revenue or new customer growth? Are you trying to expand internationally? Every type of strategy and what you really want out of the year will dictate what needs to happen in the preceding months. And yeah, just get very, very clear on that. It might sound very basic, but get very clear on what you want out of the next year.
Definitely. I think with that, again, that typical SWOT analysis, what are the strengths, weaknesses, opportunities, and threats that my business or our business has that we can potentially use as a point of leverage, or, an area for concern for the new year? For example, are we launching new products? Or maybe did we launch new products last year that we don't expect to repeat? That's going to be a blip in the year that ultimately needs to be reflected in the new approach. Do you feel like each of your individual channels really, you hit the ceiling with them? Was your website starting to buckle under the pressure? Is there more investment needed? Does it support the scale? Do you feel there's more room in your paid advertising? Are you hitting that the point of diminishing marginal returns at your current level of return? Realistically, if it's a case where you don't feel like you can push your social advertising anymore, there's no point blindly setting your revenue targets as 20, 30, 40% higher if you don't have any meaningful way of getting there. So understanding what kind of critically needs to be done in terms of reaching that overall goal, I think is very important. And I suppose to go to the next point then around making sure we can tie that together with the overall plans for the business. What you want to, there's always these constant conflicts. You want to make sure ultimately that you're setting yourself up for a really strong year, but you don't want to do that at the risk or at the destructive. You don't want to hurt the business long term, I suppose. Now, if you're looking at purely short term thinking that the 31st of December 2024 is D-Day and there's going to be no more operations after that, you would have a fantastic year. If you were really to squeeze everything out of the business, you would potentially over discount. You would really push the sales. You would operate in a different kind of methodology. You need to make sure, okay, you're going to wake up, on the 1st of December 2025, maybe with a sore head, and realize, okay, I have another year of work ahead of me. Have I set myself up for the long term? And that's another big piece that critically, around making sure you're, acquiring enough new customers and not just trying to squeeze as much as you can out of existing ones.
Yeah, no, yeah, 100%. And yeah, that's probably the marketing side of things as well. Like, I would look at what's typically probably some of the more boring aspects of an e-commerce business, and like on the cost side of things, like there is easier ways to get to profitability that don't necessarily just mean increasing your ad spend, increasing contribution margin. Again, there is ways to reduce your operating costs, and I think we've seen this year there's often a lot more scope to reduce operating costs than you might think. Like, on the flip side of that, in the one potential case where it might be good to reduce contribution margin is if you can also reduce your operating expense at the same time. If you are someone who fulfills in-house and you have a warehouse and maybe you have staff on and you maybe only have one or two peaks of the year, that warehouse could be costing you a lot of money. Maybe it could be a worthwhile venture to do a bit of a study to understand, do we need the warehouse, or should we actually just move to a 3PL where we actually can just use the kind of scale up nature of a 3PL when we need it, and actually pay that extra bit of cost on the cost of goods line, as opposed to incurring a massive operating expense all year round. Because again, we've seen that one kind of I suppose impact a lot of businesses. So yeah, everything you've said there I completely agree with on the marketing side of things, but I would look at the business in a holistic view and really look at the more boring aspects of the business as well, that often where there can be really marginal gains made.
Great point. I think ultimately as well, translating those overarching sales and profit goals into what that actually ultimately means at each level of the P&L or each level of the forecast. If you want to reach, for every maybe €1,000,000 or dollars in revenue you want to reach, that sets a certain level of new customer revenue and existing customer revenue expectations. It's going to set an expectation for your email marketing. What level of kind of Facebook ads contribution does that need to play in terms of this overarching sales revenue it drives? What can I take as my cost of goods, my average order value? What are the orders associated with that? it's a lot easier naturally to break down an overarching goal if we understand what the component parts are, both in terms of those variable costs elements, the operational expenses, and then that marketing engine you're trying to build. So I know, Thomas, from your perspective, you've done a lot of work with brands around kind of planning for 2024 and actually starting to understand how those different sides of the coin may interact and affect each other. Maybe you can run through a bit of an activity there.
Yeah, sure. I might just pop up on my screen here. Perfect. So this is kind of a brief 2024 planner. So essentially what we're trying to do here is map out, okay, what's your net sales goal for the year? What is your typical cost of goods, or obviously the inverse there is your gross profit margin? What are your operating expenses for the year? What are you projecting? And actually what profit goal do you want out of the business next year? Because often when you kind of get these four pieces in line, the marketing required to get there, people often have a lot more room to push than they actually initially think. So what we've done here is looked at a business here that has €1 million net sales targets. Just be very, very careful. This is not Shopify nets. This is not Shopify sales. We are stripping out the VAT, the discounts, refunds, and taxes there. So, okay, we've said we want €1 million in net sales next year. We have our cost of goods of 70%. So we have 700K in cost of goods. That means we only have a gross profit margin of 30%. We've operating costs of 90K, so just nearly 91K, and this business wants a 10% net profit margin at the end of the year. So really what we're trying to do is pop in a lot of the variables and then obviously kind of work backwards and say, okay, if you actually want to achieve this and you want that 10% net profit on that €1 million in sales, now we need to figure out, okay, what's the next variable? Well, it's your marketing spend. What is the marketing spend required for you to go ahead and actually achieve this? So, for instance, if we were to dial this up to, okay, I actually want 5%. Okay, now we're actually going to be able to spend a lot more to get there. So we're going to see the increase, the marketing required here to get there increase, and the marketing efficiency. So we can spend more at a less efficiency to get there because we're requiring a lesser profit number. So this 100K is going to drop down. I'm just going to go ahead and click enter here. Okay, so as you can see now, originally we started at 109 in marketing spend to get there at a 9.16 MER. And we say, okay, I'm actually fine with a 5% net profit margin. We can say now, okay, assuming we still have the exact same sales number, we can now get there with 160K, call it, of marketing spend. And that marketing spend only needs to be 6.28 efficiency, I suppose. And again, assuming your operating expenses stay the exact same and you can hold on to that gross profit margin or that cost of goods margin, you will achieve your 5% net profit margin. This is a really, really interesting exercise for a lot of brands because it does give you a lot more clarity sometimes in terms of what's actually possible. Let's flip this on its head now and say, okay, this brand actually has, 40% COGS. So we're going to have a 60% gross profit margin. Okay, so now we can see that the brand has €1 million in sales. They have a 40% COGS, which means that the gross profit on the business is now 60%. Okay, so let's just kind of quickly go back. The brand was operating at a 70% COGS. So we're not changing anything, only the gross profit line here. But as we change the cost of goods percentage and the gross profit percentage here, everything else in the business is going to change as well. So we're still saying we only want 5% net profit. So we're still going to take 50K out of it, but watch how the marketing spend required to hit that sales goal and profit goal changes as we change the business from a gross profit percentage of 30 to a gross profit percentage of 60. So go ahead and do that now. So we can see gross profit percentage is 60, but now to acquire the exact same amount of sales, €1 million in sales, and achieve that 50%, that 5% net profit margin, the business can actually spend just under $500,000 to now achieve that. So this is a really, really interesting exercise for businesses. Okay, pop in what the sales goal looks like. What does your gross profit or your cost of goods percentages look like? What are your operating expenses for the year looking like? And actually, what is your profit goal for the business? This is really, a really important one at the end. So I just make sure everyone to kind of try to carry out an exercise like this. And if you would like a copy of the spreadsheet, please just drop us a DM and we're more than happy to run through it with you.
Definitely a really interesting exercise to really put in perspective what kind of marketing investment is realistically needed to hit the goals we want to reach, and also making sure people keep an eye on that efficiency piece. If it's a case where reaching the sales goal you want requires your marketing to be so efficient and efficient to the point it never has before, that's a good indication that maybe something's off here. We need to reassess, okay, do we need to expect less of a net profit margin realistically to hit the overarching sales goal? Maybe we can expect a lesser sales goal and keep profit more front of mind. So definitely a really interesting exercise for people to work through. If it's a case we'd like some help on this, again, we've been working through that growth planning process with clients over the tail end of 2023 and now into 2024. So be more than happy to do so. So thanks for the time, everyone. And yeah, looking forward to chatting soon.